Hello, and welcome to our comprehensive guide on investment banking. Over the next 15 chapters, we will pull back the curtain on one of the most powerful, misunderstood, and vital industries in the global economy. You've probably heard the term investment banking thrown around in movies, news headlines, or discussions about the stock market. It often conjures images of Wall Street, high-stakes deals, and fortunes being made or lost in the blink of an eye. But what does it really mean? What do these financial professionals actually do? And why does it matter to anyone outside of a skyscraper in New York City? This series is designed for beginners, for anyone who is curious and wants to understand the engine that powers modern capitalism. We will demystify the jargon and break down the complex concepts into understandable pieces. Before we dive in, it is absolutely essential to start with a very important disclaimer. The content in this entire series is for informational and educational purposes only. It is not, and should not be considered financial, investment, legal, or tax advice. We are not licensed financial advisors, and the information presented here is based on publicly available knowledge and general industry principles. Financial markets are complex and involve significant risk. Always consult with a qualified and licensed professional before making any financial decisions. This series aims to educate you on the what and the how of investment banking, not to advise you on what you should do with your money. Our goal is to provide a clear, unbiased, and educational overview that complies with all regulations and guidelines. So, with that crucial point established, let's begin with the most fundamental question. What is an investment bank? At its very core, an investment bank acts as a financial intermediary. Think of it as a highly specialized bridge. On one side of the bridge, you have entities that need capital. Large corporations, startups, and even governments. They need money to fund new projects, expand their operations, develop new technology, or build infrastructure. On the other side of the bridge, you have entities that have capital and are looking for places to invest it to generate a return. These are investors such as pension funds, mutual funds, insurance companies, and very wealthy individuals. The investment bank is the expert architect and engineer that designs, builds, and manages this bridge. It connects those who need money with those who have it, facilitating a transaction that ideally benefits both parties. The company gets the fuel it needs to grow, and the investor gets the opportunity to see their capital grow. This is a critical distinction from the bank you likely use every day. That's called a commercial bank or a retail bank. Your local commercial bank takes deposits from individuals and businesses, secures them in checking and savings accounts, and then provides loans for things like cars, homes, and small businesses. Its primary business is lending money that it has taken in as deposits. An investment bank, on the other hand, doesn't typically take deposits in the same way. Its main function is not to give you a mortgage. Instead, it operates in the world of capital markets. It helps companies raise money by issuing and selling securities. What are securities? Simply put, they are financial instruments that represent some type of value. The two most common types are stocks and bonds. When a company wants to raise money by selling stocks, it's essentially selling small pieces of ownership in itself. This is called equity financing. When a company sells bonds, it's borrowing money that it promises to pay back with interest over a set period. This is called debt financing. Investment banks are the experts who manage these processes. This core function is known as underwriting. When an investment bank underwrites a deal, it often guarantees to the company that it will raise a certain amount of money. The bank might buy the entire issuance of new stocks or bonds from the company, and then take on the risk of selling them to investors in the market. For taking on this risk and for their expertise, the bank earns a fee, which is often a percentage of the total capital raised. This is one of their primary sources of revenue. Now let's break down the main activities within an investment bank to get a clearer picture. Generally, an investment bank's work can be split into two major areas: the sell side and the buy side. The term investment banking most commonly refers to the sell side activities. The sell side is focused on creating, promoting, and selling securities. This includes the classic investment banking division, or IBD, which is what most people think of when they hear the term. The IBD is further broken down into product groups and industry groups. Industry groups focus on specific sectors like technology, healthcare, or energy. They build deep knowledge about the companies and trends in their specific field. Product groups specialize in certain types of financial transactions, like mergers and acquisitions, M&A, or capital markets. Let's touch on the two most famous functions of the IBD. First, capital markets. This is exactly what we just discussed, helping companies raise money. This can be through an initial public offering, or an IPO, which is when a private company first sells its stock to the public, becoming a publicly traded company. It could also be a secondary offering, where an already public company sells more stock. Or it could be through issuing various types of bonds. The investment bankers in these groups advise the company on the best time to go to market, the right price for their securities, and then they execute the deal. Second, mergers and acquisitions, or M&A. This is arguably the most glamorous side of the business. M&A advisors, as the name suggests, advise companies on buying other companies, selling themselves to another company, or merging with a peer. These are incredibly complex transactions that require deep financial analysis, valuation, negotiation strategy, and project management. An investment bank might help a large tech company figure out which smaller startup to acquire to gain a competitive edge. Or they might help a company that wants to sell itself find the best buyer and get the highest possible price. These deals can be worth billions, even hundreds of billions of dollars, and the advisory fees are substantial. Beyond the IBD, other parts of the sell side include sales and trading, and research. Equity research analysts study public companies and make recommendations to investors on whether to buy, sell, or hold their stock. Their reports provide valuable information to the market. The sales and trading division is the bank's connection to the financial markets. Sales professionals work with the big investors, like mutual funds and hedge funds, to sell them the securities the bank is underwriting. Traders, on the other hand, buy and sell stocks, bonds, and other financial products on behalf of the bank or its clients, trying to make a profit from market movements. So to summarize the sell side, it's all about providing services to corporations to help them raise capital or engage in strategic transactions, and then selling the resulting financial products to investors. The buy side, in contrast, refers to the investors themselves, the clients of the sell side. This includes asset management firms, hedge funds, pension funds, and private equity firms. They are in the business of buying assets and securities with the goal of growing their capital. While they are a separate part of the financial ecosystem, many large banks have their own asset management divisions, which are part of the buy side. So, why does any of this matter to the economy and to you? Investment banking is a critical lubricant for economic growth. When a promising new biotechnology company can raise money through an IPO, it can fund research that might lead to a life-saving drug. When two companies merge, they may become more efficient, leading to better products or lower prices for consumers. When a city government issues bonds with the help of an investment bank, it can build new schools, bridges, and hospitals. Without this mechanism for efficiently allocating capital from those who have it to those who need it for productive purposes, our economy would be far less dynamic. Innovation would slow down, job creation would suffer, and large-scale projects would be nearly impossible to finance. In this first chapter, we have laid the foundation. We've defined investment banking as the critical intermediary that connects capital with opportunity. We've differentiated it from commercial banking, and we've introduced the core functions of raising capital through underwriting and advising on strategic deals like mergers and acquisitions. As we move forward in this series, we will dive deeper into each of these areas. In our next chapter, we will explore the world of mergers and acquisitions in much greater detail, looking at the anatomy of a deal from start to finish. We will continue to build on this blueprint, giving you a comprehensive understanding of the role, function, and impact of investment banking. Thank you for joining us. Welcome back to our Beginner's Guide to Investment Banking. In our first chapter, we established the foundational concept of an investment bank as a vital financial bridge, connecting companies that need capital with investors who provide it. We briefly introduced two of the most prominent functions within a bank's investment banking division: helping companies raise capital and advising on mergers and acquisitions, or M&A. Today, we are going to dive deep into that second function, exploring the high-stakes world of M&A. As always, let's begin with our important reminder. This chapter and this series are for educational and informational purposes exclusively. The concepts discussed here are simplified to explain the general mechanics of M&A and should not be interpreted as financial, investment, or legal advice. Every transaction is unique and complex, and professional consultation is essential for any real-world application. Our goal is to provide you with knowledge, not guidance. So what exactly are mergers and acquisitions? The term M&A is often used as a single catch-all phrase, but it actually describes two distinct types of corporate transactions. First, let's talk about a merger. In its purest form, a merger is the combination of two companies, typically of similar size, into one new single legal entity. Think of it like two equally powerful rivers flowing together to create an even larger, more powerful river. The original companies technically cease to exist, and a brand new company is formed, often with a new name. Shareholders of both original companies receive shares in the new, combined entity. This is often referred to as a merger of equals. Next, we have an acquisition. This is a more common scenario, where one company, usually the larger one, purchases and absorbs another company. In this case, the acquiring company, or the acquirer, remains, while the target company is completely integrated into it and ceases to exist as an independent entity. To use our river analogy, this is like a small stream being absorbed by a massive river. The stream adds to the river's volume, but loses its separate identity. A famous real-world example is when Facebook acquired Instagram. Instagram continues to exist as a product, but as a company, it is wholly owned and controlled by its parent, now called Meta. Whether it's a merger or an acquisition, the fundamental question is always, why? Why would companies go through such an enormously complex, expensive, and time-consuming process? The answers lie in a core business concept called synergy. Synergy is the idea that the combined value and performance of two companies will be greater than the sum of the separate, individual parts. The simple math is that 1 + 1 = 3. Investment bankers and company executives spend countless hours trying to identify and quantify these potential synergies. These synergies can be broken down into two main categories. First, there are cost synergies. This is the most common and easily measurable driver of M&A. When two companies combine, you can often eliminate redundant functions and reduce overall costs. For example, the new combined company doesn't need 2 CEOs, 2 chief financial officers, or 2 separate human resources departments. You can consolidate office space, manufacturing plants, and technology systems. By streamlining operations and gaining economies of scale, the new company can become more profitable than the two were on their own. Second, there are revenue synergies. These are often harder to achieve, but can be incredibly powerful. This is the idea that the combined company can generate more sales than the two standalone companies could. For instance, a company with a strong product line, but a weak sales force could acquire a company with an excellent distribution network. By putting its products into that new, larger network, it can dramatically increase its sales. Another example is cross-selling, where the combined company can sell Company A's products to Company B's customers, and vice versa. Beyond synergy, there are other powerful motivations for M&A. A company might acquire a competitor to increase its market share and reduce competition. It might acquire a company in a completely different industry to diversify its revenue streams and reduce its dependence on a single market. In the fast-moving world of technology, acquisitions are often about buying innovation and talent. A large, established tech company might find it quicker and more effective to buy a small, nimble startup that has developed a groundbreaking piece of technology, rather than trying to build it from scratch. This is sometimes called an acqui-hire, where the primary goal is to acquire the startup's brilliant team of engineers. So where do investment bankers fit into this picture? They are the expert advisors, the architects and strategists who guide companies through every stage of the M&A process. They typically work on one of two sides of a deal. On the sell side, the investment bank is hired by the company that wants to be acquired, the target company. The banker's job is to get the best possible outcome for their client. This means achieving the highest possible price and the most favorable terms. To do this, they prepare detailed marketing materials about the company, identify and contact a list of potential strategic buyers, manage a competitive auction process to drive up the price, and lead the complex negotiations on behalf of the seller. On the buy side, the investment bank is hired by the company that wants to do the acquiring. Their role is to help the client identify potential target companies that fit its strategic goals. Once a target is identified, the bankers perform a deep analysis to determine what it's worth, a process called valuation. This is a critical step to ensure the acquirer doesn't overpay. They also help structure the deal, figure out the best way to finance the purchase, and negotiate the terms with the sell-side advisors. A crucial part of any buy-side assignment is due diligence. You can think of this as the ultimate corporate investigation. The buyer's bankers, along with lawyers and accountants, meticulously examine every aspect of the target company. Its financial statements, its contracts with customers and suppliers, its legal history, its intellectual property, and its internal operations. The goal is to uncover any hidden risks or liabilities before the deal is signed. It's like getting a thorough inspection before you buy a house. You want to make sure there are no hidden cracks in the foundation. The entire M&A process, from the initial idea to the final closing, can take many months, sometimes even years. It starts with strategy, moves into identifying targets or buyers, then proceeds through valuation, negotiation, due diligence, and finally, the signing of a definitive agreement and the official closing of the transaction. The investment banker is the project manager and trusted advisor through this entire marathon. In conclusion, mergers and acquisitions are powerful tools that companies use to grow, adapt, and compete. They are driven by the search for synergies, market power, and innovation. And at the very center of these complex, transformative deals, you will find the investment banker, providing the expert valuation, strategic advice, and negotiation skills needed to bring the deal to life. In our next chapter, we will explore the other side of the coin, the capital markets. We'll examine exactly how companies raise the billions of dollars often needed to fund these massive acquisitions, or to fuel their organic growth. Thank you for joining us. Hello and welcome back to our series, A Beginner's Guide to Investment Banking. In our last chapter, we took a deep dive into the world of mergers and acquisitions, exploring why a company might spend billions of dollars to buy another. That brings up a critical question. Where does all that money come from? How do companies raise the massive sums of capital needed not only for acquisitions, but also to build new factories, conduct research, and expand into new territories? The answer lies in the vast, dynamic world of the capital markets. Before we proceed, we must reiterate our standard disclaimer. This content is for educational purposes only. The discussion of stocks, bonds, and other financial instruments is meant to explain their function from a corporate finance perspective. It is not investment advice, nor is it a recommendation to buy or sell any security. Financial markets involve inherent risks, and all investment decisions should be made in consultation with a qualified, licensed financial professional. So, what are the capital markets? At the highest level, the capital markets are the arenas where those who have capital, the investors, provide it to those who need capital, the corporations and governments. It's a broader ecosystem than just a single bank. To understand it, we first need to distinguish between two fundamental areas: the primary market and the secondary market. The primary market is where new securities are born. When a company decides it wants to raise money by selling stocks or bonds for the very first time, it does so in the primary market. The key feature here is that the money from the sale of these securities goes directly to the company itself. Think of it like buying a brand new car directly from the manufacturer's factory. The manufacturer gets your money, and you get a new car. This is where investment bankers operate as underwriters, facilitating this initial sale. The secondary market, on the other hand, is where those securities are traded after they have been issued. This is what most people think of as the stock market. Platforms like the New York Stock Exchange, NYSE, or the Nasdaq. Here, investors buy and sell existing securities among themselves. The company whose stock is being traded does not receive any money from these transactions. To use our car analogy again, this is the used car market. When you sell your car to another person, you get the money, not the original car manufacturer. You might wonder, if the company doesn't get any money, why is the secondary market so important? Because it provides liquidity. Liquidity is the ability to easily buy or sell a security. Without a healthy secondary market, investors would be very hesitant to buy new securities in the primary market, because they would have no easy way to sell them later. A vibrant secondary market gives investors confidence, which is essential for the primary market to function. Now let's focus back on the primary market, where companies raise their fuel. There are two main highways a company can take to raise capital: equity and debt. The investment bank divisions that specialize in these are called equity capital markets, ECM, and debt capital markets, DCM. Let's start with equity capital markets, or ECM. Equity represents ownership. When a company raises money through equity, it is selling small pieces of itself, known as shares or stock, to investors. These investors, now shareholders, become part owners of the business. The most famous transaction in the ECM world is the initial public offering, or the IPO. This is the process through which a private company, perhaps one started in a garage and funded by venture capitalists, sells its stock to the general public for the very first time. By doing so, it becomes a publicly traded company. Why would a company go public? The primary reason is to raise a significant amount of capital for growth. It also raises the company's public profile, creates a liquid market for its shares, and allows early employees and investors to cash out some of their holdings. The investment banker's role in an IPO is central. They act as the underwriter, guiding the company through an intense and highly regulated process. This involves conducting thorough due diligence, preparing the extensive legal and financial disclosure documents required by the Securities and Exchange Commission, or SEC, most notably a document called the S-1 prospectus. The bankers then help management craft their story and take them on a roadshow, where they pitch the company to large institutional investors like mutual funds and pension funds to build demand for the stock. Finally, the bankers help set the final IPO price and allocate the new shares to investors. The other main route for raising capital is through debt capital markets, or DCM. Instead of selling ownership, here the company is essentially taking out a very large loan. It does this by issuing bonds. A bond is a formal contract between the issuer, the company, and the investor. The company promises to pay the investor periodic interest payments, known as the coupon, over a specified period, and then to repay the original loan amount, called the principal, on a specific date, known as the maturity date. Companies often choose to issue debt because it allows them to raise capital without diluting the ownership of their existing shareholders. The interest payments on debt are also typically tax-deductible, which can make it a cheaper source of financing than equity. Investment bankers in the DCM group advise the company on the optimal structure for the bond, what the interest rate should be, how long the term should be, and then use their institutional sales force to sell the bonds to investors who are looking for a steady income stream, like insurance companies and bond funds. So, how does a company choose between issuing equity and issuing debt? It's a fundamental strategic decision with major trade-offs. With equity, you are selling ownership. This means new shareholders get a say in how the company is run and a claim on its future profits. But there's no legal obligation to repay the money raised. With debt, you do not give up any ownership or control. However, you create a legal obligation to make fixed interest payments and to repay the principal in full. Failing to do so can lead to bankruptcy. From an investor's perspective, the risk and reward are also different. Equity is generally considered riskier because if the company performs poorly, the stock price can fall to zero. However, it also offers unlimited upside potential as the company grows. Debt is typically safer. As long as the company remains solvent, you will get your interest payments and your principal back. The trade-off is that your return is capped at that agreed-upon interest rate. In summary, the capital markets are the lifeblood of the economy. They provide the essential function of channeling funds to where they are needed most. Investment banks are the gatekeepers of the primary market, using their expertise in equity capital markets and debt capital markets to help companies choose the right path and execute the complex transactions required to raise the billions of dollars that fuel growth, innovation, and strategic acquisitions. In our next chapter, we will cross the Chinese wall within the investment bank to explore the fast-paced world of sales and trading, the division that lives and breathes in the secondary markets. Thank you for joining us. Welcome back to A Beginner's Guide to Investment Banking. In our previous chapters, we focused on the investment banking division, or IBD, which operates in the primary market, helping companies raise capital through IPOs or advising them on multi-billion-dollar mergers. Today, we journey to a completely different part of the bank, a world that is faster, louder, and lives and breathes the pulse of the secondary markets. Welcome to the trading floor, the home of the sales and trading division. Before we step onto this dynamic floor, we must first understand a critical concept that separates it from the rest of the bank: the Chinese wall. This isn't a physical wall, but a strict, mandatory information barrier. The IBD side of the bank possesses confidential, non-public information about its clients' secret M&A plans or upcoming capital raises. The Sales and Trading, or S&T division, on the other hand, operates in the public markets. For them to use that confidential information to trade would be illegal insider trading. The Chinese wall is the ethical and legal separation that prevents this, ensuring market integrity. And as we discuss the mechanics of trading, please remember our essential disclaimer. This is a purely educational overview of how a bank's S&T division functions. It is not a guide to personal trading, nor is it investment advice. The activities described are performed by highly regulated professionals in an institutional context. Now let's step across that wall. The environment on a trading floor is a stark contrast to the project-based world of IBD. Instead of working on a deal for months, the S&T professionals' world is measured in seconds. Their days are driven by live market data, economic news releases, and geopolitical events. Their primary purpose is to serve the bank's institutional clients, the buy-side firms like hedge funds and mutual funds, by facilitating their buying and selling of securities in the secondary market. The S&T division is built on two distinct but deeply interconnected pillars: sales and trading. Let's start with the sales team. Think of a salesperson in this context not as someone selling a product, but as a high-level relationship manager and information conduit. Each salesperson covers a specific list of institutional clients. Their job is to know their clients' investment strategies inside and out. They are on the phone or messaging their clients all day, providing market analysis, sharing relevant reports from the bank's research division, and pitching trade ideas that align with the client's goals. When a large pension fund decides it wants to buy 10 million shares of a particular stock, their first call is to their trusted salesperson at an investment bank. The salesperson is the client's window into the bank's resources. They coordinate access to research analysts, new bond issuances, and most importantly, the bank's traders. This brings us to the second pillar, the trading team. If the sales team is the relationship hub, the trading team are the market execution experts. Traders sit at desks, each specializing in a specific asset class. There might be a U.S. equities desk, a government bonds desk, a foreign exchange desk, and so on. Their world is a constellation of screens displaying real-time prices, news feeds, and risk metrics. When a salesperson brings them a client's order, it is the trader's job to execute it in the market as efficiently as possible. A core function of many trading desks is market making. This is a vital service that provides liquidity to the market. A market maker continuously quotes two prices for a security: a bid price, which is the price they are willing to buy the security at, and a slightly higher ask price, which is the price they are willing to sell it at. The small difference between these two prices is called the bid-ask spread. Imagine a currency exchange booth at the airport. They might buy US dollars from you at one rate and sell them to you at a slightly less favorable rate. That small difference is their profit for providing the convenience of an immediate transaction. A market-making trader does the same thing, but for millions of shares of stock or bonds, at lightning speed. By always being ready to buy or sell, market makers ensure that investors can always find a counterparty for their trade, making the market smooth and efficient. This market-making activity means the trader is constantly managing the bank's inventory of securities, known as their book. Their job is to manage the risk associated with holding these positions while trying to profit from the bid-ask spread on a massive volume of trades. It's important here to distinguish between two types of trading. The first is agency trading, where the bank acts purely as an agent or middleman, executing a client's order in the open market for a commission. In this case, the bank takes on no risk itself. The second type is proprietary trading, where the bank trades with its own capital to make a direct profit for itself, not for a client. For many years, this was a huge profit center for banks. However, in the aftermath of the 2008 financial crisis, U.S. regulators sought to reduce the risks large banks could take with their own money. This led to the creation of the Volcker Rule, a key piece of legislation under the Dodd-Frank Act. The Volcker Rule significantly restricts the ability of large, deposit-taking banks in the U.S. to engage in proprietary trading. The result is that today, the vast majority of trading activity at major U.S. investment banks is client-focused, centered on market making and agency trading to facilitate client orders, rather than making large, speculative bets with the bank's own capital. Finally, we can't talk about S&T without mentioning the research division. Research analysts are the subject matter experts who study companies and industries, publishing detailed reports with recommendations to buy, sell, or hold a particular stock. This research is a key product that the sales team provides to their clients, adding value and helping them make informed investment decisions. The Chinese wall ensures that this research is independent and unbiased by any deals the investment banking division might be working on. In summary, the sales and trading division is the bank's dynamic, market-facing arm. It operates on the other side of the Chinese wall from IBD, serving institutional clients in the secondary markets. The sales team manages client relationships, while the trading team provides crucial liquidity through market making and executes trades. This entire operation is informed by independent research and operates within a strict regulatory framework shaped by rules like the Volcker Rule. In our next chapter, we will zoom out to look at the landscape of the industry itself, exploring the different types of investment banks, from the massive bulge bracket firms to the specialized elite boutiques. Thank you for joining us. Hello and welcome back to our beginner's guide to the world of investment banking. In our journey so far, we have explored what investment banks do, from advising on massive mergers and acquisitions to raising capital and facilitating trades in the global markets. Now we're going to shift our focus to who these firms are. The term investment bank covers a wide and diverse ecosystem of companies.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
And not all of them are the same. Today, we will map out the landscape of the industry, looking at the different categories of banks that operate within it. As we discuss different types of firms, please keep in mind our standard disclaimer. This chapter is for informational and educational purposes only. The classification of firms is based on common industry understanding and is intended to explain their different business models. It is not an endorsement or recommendation of any specific firm, nor is it financial advice. When people think of investment banking, they usually picture the titans of the industry. These are known as the bulge bracket investment banks. The term bulge bracket is a colloquialism for the largest multinational, full-service investment banks in the world. The exact list of firms in this category can evolve over time due to mergers and market shifts, but the defining characteristics remain the same. Firms that are typically considered part of this group are household names like J.P. Morgan, Goldman Sachs, and Morgan Stanley. The key feature of a bulge bracket bank is its full-service model. They are the financial supermarkets for the largest corporations and governments on the planet. They have massive, highly developed divisions in every major area we've discussed: mergers and acquisitions, equity and debt capital markets, sales and trading, research, and often, vast asset and wealth management arms. Their second defining trait is their immense global reach. With offices in every major financial center from New York to London to Hong Kong, they can execute complex, cross-border transactions seamlessly. The third, and perhaps most critical, advantage of a bulge bracket bank is its balance sheet. They have access to enormous amounts of capital, which allows them to underwrite the world's largest IPOs and provide billions of dollars in financing to help a client complete an acquisition. Their clients are typically the Fortune 500, sovereign governments, and the largest institutional investors. If a deal is a multi-billion-dollar mega deal featured on the front page of the Wall Street Journal, it's almost certain a bulge bracket bank is involved. Competing directly with these giants, especially in the prestigious M&A advisory space, is a different type of firm: the elite boutique investment bank. These are smaller, more specialized firms that have built powerful reputations for their expertise and high-level advice. Firms often placed in this category include names like Lazard, Evercore, and Centerview Partners. The business model of an elite boutique is fundamentally different from a bulge bracket. Their primary, and sometimes only, focus is on advisory services, specifically providing strategic advice on complex mergers and acquisitions, corporate restructurings, and other significant transactions. Unlike the bulge brackets, they generally do not have large sales and trading divisions, nor do they engage in the same kind of large-scale lending or underwriting. This is a key part of their value proposition. They can market themselves as providing pure, independent, and unconflicted advice, because they are not trying to cross-sell other products like financing or trading services to their clients. While they also advise some of the largest corporations in the world on their most important deals, they do so with a much leaner structure, smaller deal teams, and a promise of more senior-level attention. Their competitive advantage is not a massive balance sheet, but the depth of their expertise and the quality of their advice. So we have the giants and the specialized experts, but they don't represent the whole industry. A vast and critically important segment of the market is served by middle-market investment banks. These firms are the backbone of the broader corporate finance world, even if they don't always grab the headlines. As the name suggests, middle-market banks serve middle-market companies. These are businesses that are significantly larger than a Main Street small business, but not as massive as a global Fortune 500 corporation. While definitions can vary, you can generally think of these as companies with annual revenues somewhere between $50 million and perhaps $1 or $2 billion. Middle market banks work on a higher volume of smaller deals. An M&A transaction might be for $100 million, not $50 billion. They help these growing companies sell themselves to larger corporations, raise capital to fund expansion, and navigate their own strategic challenges. Many of these banks, like Baird or William Blair, offer a full suite of services, including M&A advisory, capital raising, and research, but they are scaled to the needs of their middle market client base. Many also have a strong regional focus, with deep roots and relationships in certain parts of the United States. These banks are absolutely vital to the health of the economy, as they provide the essential capital and advice that allow the vast majority of American companies to grow, innovate, and create jobs. So, let's quickly summarize the key differences. Bulge bracket banks are defined by their global scale, full-service product suite, and massive balance sheet. Elite boutiques are defined by their specialized focus on advisory, their independence, and their senior-level expertise. And middle market banks are defined by their focus on the vast and vital segment of mid-sized companies. Understanding this landscape shows that the investment banking industry is not a monolith. It is a diverse ecosystem with different types of firms structured to serve the unique needs of different clients, from a $100 million family-owned business in the Midwest to a $500 billion global technology conglomerate. Now that we have a map of the industry and understand the different kinds of firms, our next chapter will take us inside one of these banks. We'll explore what the work is actually like at the ground level by looking at a day in the life of an investment banking analyst. Thank you for joining us. Welcome back to our beginner's guide. In the last chapter, we mapped out the investment banking industry, from the global bulge bracket firms to the specialized elite boutiques. We've seen the firms from a 30,000-foot view. Now we're going to zoom all the way into the ground level. We'll spend today walking in the shoes of the person who is often the first to arrive after the cleaners have left and the last to leave before they return. The investment banking analyst. Before we begin, it's important to state our usual disclaimer. This chapter provides a generalized depiction of the analyst role, and is for informational and educational purposes only. The experience can vary greatly depending on the bank, the specific group, and even the day of the week. This is not career advice, nor is it a guarantee of any specific work experience. Our goal is simply to illustrate what the job itself often entails. The investment banking analyst is typically a recent graduate from a university. They are the most junior members of a deal team, and they are the engine room where the foundational work gets done. While they are at the bottom of the hierarchy, they are at the center of the action. Their day doesn't follow a predictable 9 to 5 schedule. It is dictated entirely by the demands of the deals they are working on. Our analyst's day might begin around 9 o'clock or 9:30 a.m. This might seem late, but it's often because the previous night ended at 2 or 3 a.m. The first order of business is to triage an inbox flooded with overnight emails from senior bankers in different time zones and from clients. They'll scan the financial news to see if any market-moving events have affected their clients or the industries they cover. Shortly after, the analyst will sync up with their direct manager, the associate. This meeting sets the priorities for the day. The analyst is usually staffed on multiple projects simultaneously, perhaps 2 live M&A deals and 1 pitch, which is an effort to win a new client. The associate will outline the key tasks for the day. For the live deal, the client needs to see an updated valuation by the end of the day. For the pitch, we need to build a new section on potential acquisition targets. Let's get drafts of those slides done by this evening. The analyst gets to work. A core morning task might be updating a complex financial model in Excel. Let's say a client has just released its quarterly earnings. The analyst's job is to meticulously input these new financial results into the valuation models they have built. This isn't just data entry. It requires understanding how changes in revenue or costs flow through the entire model and affect the company's ultimate valuation. It's like being an architect who has to update the building's blueprints with new material specifications to see how it changes the structure's strength and value. Lunch is rarely a break. It's typically ordered in and eaten at the desk in about 15 minutes, while working through tasks. The afternoon is often dedicated to one of the most fundamental analyst responsibilities: creating presentations. In investment banking, these are often called pitch books or decks. These are incredibly detailed PowerPoint presentations that the senior bankers use to communicate their ideas to clients. The analyst is responsible for creating the nuts and bolts of these presentations. This involves gathering data from financial terminals like Bloomberg, researching company histories and industry trends, and building the slides that present this information clearly and concisely. They might create slides that profile a company's financial performance, summarize past M&A deals in the industry, or display the output of their valuation models in easy-to-understand charts and graphs. The attention to detail required is immense. Every number must be correct, every logo perfectly placed, and every title perfectly aligned. During the afternoon, the analyst might also be asked to join conference calls with the deal team. They are usually a silent participant, tasked with taking meticulous notes. These notes are critical, as they form the basis for the follow-up work that will inevitably be requested by the client or the senior bankers. As evening approaches, the nature of the work often shifts. Around 6 or 7 p.m., the senior bankers, the vice presidents and managing directors, are often finishing their external meetings and will turn their attention inward to review the work the junior team has produced during the day. This is a crucial feedback loop. The analyst might get an email with a PowerPoint deck they spent hours on, now covered in digital comments and markups. This is when the real late-night work often begins. The feedback, known as turns or comments, will contain a list of revisions. This valuation seems too high. Please rerun the analysis using a more conservative assumption. This slide isn't clear. Please create a new chart to visualize this data. Let's add a new section analyzing these three competitors. The analyst's job is to now execute these changes flawlessly. This can be an iterative process that goes on for hours. They will dive back into their Excel models, adjust assumptions, generate new outputs, and then update the PowerPoint slides. They will check and double-check every number, every title, and every footnote. The goal is to get a perfected version of the presentation back to the senior team for their review the next morning. It is this process of refinement and revision that often keeps analysts in the office late into the night. The work is undeniably demanding, characterized by long hours, high pressure, and tight deadlines. However, the reason many individuals are drawn to this role is the unparalleled learning experience. In a very short span, typically 2 years, an analyst is exposed to a volume and complexity of financial and strategic situations that they might not see for a decade in other industries. They develop a deep, practical understanding of valuation, financial modeling, and corporate strategy. They also build what are often called soft skills: an incredible work ethic, extreme attention to detail, and the ability to perform high-quality work under immense pressure. This foundational skill set is highly valued and transferable across the entire business world. In summary, the life of an analyst is a demanding cycle of analysis, creation, and revision. They are the indispensable engines of the deal team. And while the work is a grind, it represents one of the steepest learning curves in the professional world. Now that we've seen the view from the ground floor, our next chapter will look up the ladder. We'll explore the full deal team hierarchy, from the analyst to the associate, VP, and all the way up to the managing director, to understand how each role contributes to getting a deal done. Thank you for joining us. Welcome back to A Beginner's Guide to Investment Banking. In our last chapter, we spent a day in the trenches with an investment banking analyst, seeing the demanding, detail-oriented work they perform. The analyst is the foundation of the deal team, but they are just one part of a larger, highly defined structure. A successful multi-billion-dollar transaction isn't the work of one person, but of a coordinated team. Today, we are going to climb the ladder and explore the typical hierarchy of a deal team, from the ground floor all the way to the top. As we outline these roles, please remember our standard disclaimer. This is for informational and educational purposes only. The hierarchy described is a general industry standard, but specific titles and responsibilities can vary from firm to firm. This overview is intended to explain the function of each role within a team, not to serve as a career guide or promise of a particular career path. Think of a deal team as a pyramid. At the wide base, you have the junior bankers who handle the bulk of the analytical work. As you move up, the pyramid narrows, with each level having fewer people who bear increasing responsibility for managing projects, clients, and ultimately, bringing in business. At the very bottom of the pyramid, as we've seen, is the analyst. They are the foundation upon which everything is built. The analyst's world is one of execution. They are responsible for the detailed financial modeling in Excel, the creation of presentations and pitch books in PowerPoint, conducting industry research, and gathering the raw data that fuels every strategic recommendation. Their primary focus is on technical proficiency, accuracy, and speed. A directive given to an analyst is typically task-oriented. Please build this valuation model, or create these slides for the presentation. The next step up the ladder is the associate. The associate is the project manager of the deal team. This person is often a former analyst who has been promoted, or someone who has joined the bank after earning an MBA. They act as the crucial bridge between the junior analysts and the senior bankers. The associate takes the high-level strategic requests from the vice president and translates them into specific, actionable tasks for the analyst. A key part of the associate's job is quality control. They meticulously review the analyst's work, checking the models for errors and refining the presentations before they are sent up the chain. They also handle more complex analytical work themselves and have a much deeper understanding of the why behind the numbers. While the analyst focuses on the what, the associate begins to focus on the so what. They start to have more client interaction, though it's typically focused on the more technical aspects of the deal. Above the associate is the vice president, or VP. The VP is the primary execution officer of the deal. They are responsible for the day-to-day management of the transaction from start to finish. If the associate is the project manager, the VP is the project owner. They are the main point of contact for the client on the details of the deal, leading most of the calls and meetings. The VP has a deep understanding of every facet of the transaction, from the complex financial models to the legal intricacies of the contracts. They provide direct guidance to the associates and analysts, shaping the narrative of the presentations, and ensuring that the analysis directly addresses the client's strategic needs. The VP's world is about flawless deal execution and direct client management. They are the ones responsible for making sure the trains run on time, and that nothing falls through the cracks. As we move higher, we often find the rank of director or senior vice president. This role can be seen as a transitionary one. A director does everything a senior VP does in terms of managing deal execution, but they are also beginning to develop their own client relationships and source new business. They are, in essence, an apprentice managing director, learning how to originate deals while still being heavily involved in executing them. Finally, at the very peak of the pyramid, is the managing director, or MD. The MD is the rainmaker. Their role is almost entirely focused on two things: client relationships and revenue generation. The MD is the senior relationship manager for the bank's most important clients. They have often spent years, even decades, building trust with the CEOs and boards of directors of the companies they cover. Their primary function is to leverage these relationships to win new business for the firm. They are constantly in conversation with clients, understanding their strategic goals, and pitching them new ideas for M&A or capital raising. On a live deal, the MD provides high-level strategic guidance, leads the most critical negotiations, and uses their vast experience to navigate the most challenging parts of a transaction. They are less involved with creating the Excel models and more focused on the big picture, the client relationship, and the final outcome. So, how does this all work in practice? Imagine an MD has a coffee with a CEO who mentions they are considering an acquisition. The MD comes back to the bank and mobilizes the team. The MD and VP will strategize the approach. The VP will then direct the associate and analyst to prepare a detailed analysis of the potential target. The analyst builds the models and the slides. The associate checks the work and helps craft the story. The VP refines the presentation and manages the process. Finally, the MD leads the meeting, presenting the work and leveraging their relationship to win the business. It's a seamless flow from strategy down to execution, and from analysis back up to the client. In summary, the investment banking hierarchy is a structured and leveraged model. Each level has a clear purpose, creating a system of apprenticeship where junior bankers learn the technical skills that enable the senior bankers to focus on managing clients and generating revenue. Now that we understand the roles of the people on the team, we need to dive into their most important technical skill. In our next chapter, we will explore the art and science of valuation. How do you know what a company is worth? Thank you for joining us. Welcome back to our beginner's guide. In the last chapter, we dissected the deal team hierarchy, understanding the specific roles from the analyst to the managing director. We learned that this entire team is mobilized to serve a client's strategic needs. Today, we will explore the single most fundamental question that this team must answer, the question that lies at the heart of nearly every transaction. What is this company really worth? This process, known as valuation, is both an art and a science. The science part involves rigorous financial modeling, mathematics, and established methodologies. The art lies in the assumptions, judgments, and interpretations that are essential to the process. Now, this chapter requires our most important disclaimer yet. The following is a high-level overview of theoretical valuation methodologies used by professionals in a corporate finance context, for purposes such as M&A advisory. This is not investment advice. These techniques are complex, and this educational summary does not provide the depth necessary to perform a valuation. It is not a guide for individuals to determine if a stock is a good buy or sell. The goal is to understand the framework, not to produce a specific price for a stock. All personal investment decisions should only be made after consulting with a licensed professional. The first thing to understand is that a valuation is never a single, definitive number. It is always a range of potential values. To visualize this, bankers often use a summary chart called a valuation football field. Imagine a bar chart turned on its side. Each bar represents the valuation range derived from one specific methodology. By plotting these different bars on the same chart, you can see where they overlap and build a picture of what a reasonable, defensible valuation range for the company might be. So, what are these methodologies? Let's break down the three most common ones. First, we have comparable company analysis, often just called comps. This is a relative valuation method. The core idea is to value a company based on what other similar businesses are worth in the stock market right now. The easiest analogy is in real estate. If you want to know the value of a 3-bedroom house, the first thing you do is look at the prices of other similar 3-bedroom houses that are for sale in the same neighborhood. In banking, the process involves identifying a peer group of publicly traded companies that are similar in industry, size, and growth prospects. The analyst then calculates various valuation multiples for these peer companies. A multiple is simply a ratio, like the price-to-earnings or PE ratio, that shows how much the market is willing to pay for $1 of that company's earnings, revenue, or cash flow. The banker then takes the average or median of these multiples and applies it to the financial metrics of the company they are trying to value. The strength of this method is that it's based on live, current market data. Its weakness is that no two companies are ever perfectly identical. The second method is precedent transaction analysis, or precedents. This is also a relative valuation method, but with a key difference. Instead of looking at what similar companies are worth in the public market today, this method looks at what a buyer has actually paid to acquire similar companies in the recent past. Sticking with our real estate analogy, this isn't looking at the listing prices of houses on the market. This is looking at the final sale prices of houses that have already been sold. For this method, an analyst will research recent M&A deals involving similar target companies. They will then calculate the valuation multiples that the acquirers paid in those deals. These multiples are often higher than in a comps analysis because they include what's known as a control premium, the extra amount a buyer is willing to pay to gain full control of a company. By applying the average of these transaction multiples to the target company, bankers can estimate what a strategic acquirer might be willing to pay. Finally, we have the most academically revered method, the discounted cash flow analysis, or DCF. Unlike the other two methods, a DCF is a form of intrinsic valuation. It isn't based on what other companies are worth, but on the inherent ability of the company itself to generate cash in the future. The analogy here is buying a healthy fruit tree. You wouldn't value the tree just on the price of its wood. You would value it based on the expected value of all the fruit it will produce over its entire lifetime. A DCF analysis does the same for a company's cash flow. The process involves two main steps. First, the analyst forecasts the company's expected free cash flow over a specific period, usually 5 to 10 years. Second, they discount those future cash flows back to what they are worth today. This relies on a core financial principle, the time value of money. $1 today is worth more than $1 next year, because you could invest that dollar today and earn a return on it. The rate used to discount the future cash is called the weighted average cost of capital, or WACC, which represents the average return expected by the company's investors. The sum of all those discounted future cash flows gives you the company's estimated intrinsic value. The strength of a DCF is that it's based on a company's fundamental performance. Its biggest weakness, and where the art comes in, is that it is highly sensitive to the assumptions made about the future, which can be very subjective. In the end, no single method is perfect. Each provides a different lens through which to view a company's value. The true skill of a banker lies in synthesizing the results from all these methodologies, understanding why they might be different, and using their professional judgment to interpret the football field chart to advise their client on a fair and defensible valuation range. Now that we have a foundational understanding of how bankers determine a company's worth, we can move on to see how that valuation is used in practice. In our next chapter, we'll explore the full life cycle of a deal, following the anatomy of an M&A transaction, from the initial idea all the way to the closing announcement. Thank you for joining us. Welcome back to A Beginner's Guide to Investment Banking. In our last chapter, we delved into the art and science of valuation, learning the core methodologies that bankers use to determine a company's worth. That valuation is not just a theoretical exercise. It is a critical tool used throughout the life cycle of a real-world transaction. Today we are going to see how it all comes together. We will walk through the anatomy of a typical M&A deal, following the process from the initial idea all the way to the final closing. As we go through these steps, please keep in mind our standard disclaimer. This is a simplified and generalized overview of a common sell-side M&A process. Every single deal is unique, with its own complexities and timeline. This chapter is for informational purposes only and does not constitute financial, legal, or strategic advice for buying or selling a business. Our journey begins in what we can call Phase 1, preparation and strategy. It all starts when a company's board of directors or owner decides to explore a sale. They then engage an investment bank to act as their exclusive financial advisor. Once hired, the bankers and the company's management team work closely to prepare for the sale process. The junior bankers get to work creating a set of crucial marketing documents. The first is called the teaser. This is a brief, one-page document that provides a high-level, but anonymous, description of the company for sale. It might describe the industry, key financial highlights, and its main products, but it will not mention the company's name. The goal of the teaser is to pique the interest of potential buyers without revealing the company's identity and starting market rumors. For buyers who are intrigued by the teaser, the next document is the Confidential Information Memorandum, or CIM. This is the official sales book for the company. It's a much more detailed document, often 50 pages or more, that provides a comprehensive overview of the business, its operations, management team, financial history, and growth prospects. Before any potential buyer can receive the CIM, they must sign a legally binding non-disclosure agreement, or NDA, promising to keep all the information they are about to receive strictly confidential. This leads us to Phase 2, marketing and initial bids. With the marketing materials prepared, the senior bankers will have created a carefully curated list of potential buyers. This list typically includes strategic buyers, like competitors or companies in related industries, and financial sponsors such as private equity firms. The bankers then begin confidentially contacting these potential buyers, sending them the teaser. After signing an NDA, interested parties receive the full CIM, and are given a few weeks to review it. The investment bank then sets a deadline for them to submit a first-round bid. This initial offer is typically a non-binding indication of interest, or INI. It outlines a preliminary valuation range the buyer is considering, how they might finance the purchase, and any key questions or conditions they have. Now we enter Phase 3, due diligence and final bids. The seller and their bankers will review the first-round bids and invite a smaller group of the most serious and credible buyers to proceed to the next round. This is where the process gets much more intense. The seller opens up a virtual data room. This is a secure online portal where thousands of internal company documents are uploaded for the buyers to review. This includes everything from detailed financial statements and tax returns to major customer contracts, employee agreements, and intellectual property records. During this phase, the shortlisted buyers and their teams of advisors, their own bankers, accountants, and lawyers, conduct exhaustive due diligence. They comb through the data room to verify all the information in the CIM and to identify any potential risks or liabilities. At the same time, the buyers are typically invited to management presentations, where they have the opportunity to meet the seller's leadership team in person, hear their vision for the business, and ask detailed questions. After several weeks of this deep dive diligence, the investment bank will set a final deadline for the remaining bidders to submit their final, binding offers, often in the form of a letter of intent, or LOI. These bids are much more detailed and represent the buyer's best and final offer, informed by their extensive investigation. This brings us to the final stage, Phase 4, negotiation and closing. The seller and their board, with advice from their bankers, will evaluate the final offers. The decision isn't based on price alone. They will also consider the buyer's ability to close the deal, the proposed structure, and other key terms. They will select a winning bidder and enter into a period of exclusive negotiations. During this time, the lawyers for both sides work to draft the definitive purchase agreement. This is the final, legally binding contract that governs every single detail of the transaction. The investment bankers play a key role in negotiating the critical business and financial terms within this agreement. Once both parties sign the definitive agreement, the deal is typically announced to the public via a press release. However, the deal isn't officially done yet. There is often a period between signing and closing to secure any necessary regulatory approvals or shareholder votes. The closing is the final event. On this day, the buyer wires the money, the ownership of the company's stock is officially transferred, and the transaction is complete. In summary, a well-run M&A process acts like a structured funnel, starting wide with a broad list of potential buyers and narrowing the field through successive rounds of information sharing and diligence, ultimately leading to a successful deal with a single party. Now that we've seen the mechanics of an M&A deal, it's worth exploring one of the most important types of buyers in the market. In our next chapter, we will dive into the world of the buy side and provide an introduction to private equity. Thank you for joining us. Welcome back to A Beginner's Guide to Investment Banking. In our last chapter, we followed the intricate process of an M&A deal from start to finish. We mentioned that the potential buyers in these deals are often categorized as strategic buyers or financial sponsors.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
One of the most significant and influential types of financial sponsors is the private equity firm. For most of this series, we have viewed the world from the perspective of the investment bank, the advisor, or the sell side. Today, we are going to cross to the other side of the negotiating table and explore the world of the buy side by taking a deep dive into the business of private equity. Before we do, we must provide a very important disclaimer. Private equity is a professional, institutional asset class. The information in this chapter is for educational purposes only and is intended to explain the business model of these firms. It is not an invitation or a recommendation to invest in private equity or any similar vehicle. These investments are typically long-term, illiquid, carry significant risk, and are generally accessible only to sophisticated, accredited institutional and high-net-worth investors. So what is a private equity firm? At its core, a private equity or PE firm is an investment management company that raises pools of capital to acquire and manage companies that are not listed on a public stock exchange. The structure of a PE firm is based on a partnership model. You have the general partners or GPs, who are the investment professionals of the PE firm itself. They are responsible for raising the money, finding companies to buy, managing those companies, and eventually selling them. The capital they invest comes from limited partners, or LPs. These are the investors. LPs are typically large, sophisticated institutions like public pension funds, university endowments, insurance companies, and sovereign wealth funds. These LPs commit a certain amount of capital to a specific fund, which usually has a set lifespan, often around 10 years. For the first few years, the GPs will call this capital to make investments and buy companies. They then spend the next several years actively managing and improving these companies before ultimately selling them, or exiting the investments, in the later years of the fund's life. The signature transaction of the private equity world is the leveraged buyout, or LBO. This is the primary method PE firms use to acquire companies. The concept is simpler than it sounds. A leveraged buyout is the acquisition of a company where the purchase price is financed using a significant amount of borrowed money, or debt. The most effective way to understand an LBO is to compare it to buying a rental property with a mortgage. Imagine you want to buy a house for $500,000 to rent out. You might use $100,000 of your own savings. This is the equity. You then go to a bank and borrow the remaining $400,000 as a mortgage. This is the debt, or leverage. The house itself serves as the collateral for the loan. In an LBO, the PE firm does the same thing. They use a portion of their fund's capital as the equity, and they borrow the rest from banks and other lenders to acquire a company. The cash flow generated by the acquired company is then used to make the interest and principal payments on that debt, just as the rent from your tenant is used to pay your mortgage. The goal is to use the company's own cash flow to pay down its acquisition debt over time. The use of leverage is a powerful tool because it can magnify the potential returns on the PE firm's original equity investment. But a successful private equity investment is about much more than just using debt. After acquiring a company, the PE firm's real work begins. This is the value creation phase, which typically involves three main levers. First, operational improvements. PE firms are not passive investors. They take a very active role in their portfolio companies. They often bring in new, specialized management teams, implement more efficient business processes, upgrade technology systems, and eliminate unnecessary costs. The goal is to make the company a better, stronger, more profitable business than it was before. Second, strategic growth. A PE firm will work with company management to pursue growth opportunities. This could involve expanding into new geographic markets, developing and launching new product lines, or executing a buy and build strategy. This strategy involves using their acquired company as a platform to buy several smaller, complementary companies, known as bolt-on or add-on acquisitions, and merging them together to create a much larger, more valuable enterprise. Third, deleveraging. This is the financial component of the value creation plan. As the company operates and generates cash, it systematically pays down the debt that was used in the LBO. As the debt balance decreases, the value of the PE firm's equity ownership in the company naturally increases, all else being equal. It's the exact same principle as paying down your mortgage and building equity in your home. After a holding period of typically 3 to 7 years, the PE firm will seek to realize its investment through an exit. There are 3 common exit strategies. The most common is a sale to a strategic buyer, where the company is sold to a larger corporation in the same industry. Another is a secondary buyout, where the firm sells the company to another, often larger, PE firm. The third is an initial public offering, or IPO, where the PE firm takes the company public and sells its shares on the stock market. In summary, private equity firms are active, long-term investors that play a major role in the M&A landscape. They raise funds from large institutions to acquire companies using the leveraged buyout model. They then work intensively to improve those companies' operations and growth prospects, using the company's cash flows to pay down debt, before ultimately selling them for a profit. They are both a critical client of, and a major competitor to, the investment banks we have discussed. Now that we've been introduced to private equity, our next chapter will explore another powerful and often misunderstood player on the buy side, the hedge fund. Thank you for joining us. Welcome back to A Beginner's Guide to Investment Banking. In our last chapter, we explored the world of private equity, a buy-side player focused on taking long-term control of companies. Today, we continue our journey across the negotiating table to look at another powerful force in the financial markets, a type of firm known for its complex strategies, flexibility, and often, its mystique, the hedge fund. Before we dive in, we must emphasize our critical disclaimer. Hedge funds are private, complex, and carry substantial risk. They are structured as private investment pools accessible only to a limited number of sophisticated, accredited investors who meet specific high net worth or income requirements. This chapter is for informational and educational purposes only. It is a description of a business model and is not an endorsement, a recommendation, or investment advice of any kind. So what exactly is a hedge fund? The term itself can be misleading. The original concept, developed in the mid-20th century, was to create a fund that could hedge its bets. This meant the fund manager would not only buy assets they expected to go up in value, a long position, but also simultaneously bet against assets they expected to fall in value, a short position. The goal was to reduce overall market risk and generate positive returns, regardless of whether the market as a whole was rising or falling. Today, the term has evolved to describe a wide variety of firms. The defining characteristic of a modern hedge fund is its flexibility. To understand this, it's useful to contrast them with a more familiar investment vehicle, the mutual fund. Mutual funds are heavily regulated by the Securities and Exchange Commission, the SEC, and are available to the general public. They typically have a straightforward, long-only strategy, meaning they only buy stocks or bonds hoping they will appreciate. Hedge funds, on the other hand, are less regulated, which gives them the freedom to use a much wider and more complex array of tools and strategies. Their goal is often to achieve absolute returns, to make money in both up and down markets. Let's look at 2 of the most important tools in the hedge fund toolkit. The first is short selling. As we mentioned, this is a bet that an asset's price will decline. To put it simply, a fund manager borrows a share of a stock they believe is overvalued. They immediately sell that borrowed share at its current high price. Their hope is that the price will fall. If it does, they can then buy the share back at the new, lower price to return it to the lender. And the difference is their profit. It's a way to capitalize on a belief that a company is performing poorly. The second key tool is leverage. This means using borrowed capital to increase the size of an investment. We saw this in the private equity world with LBOs, but hedge funds often use it for shorter-term trades in public markets. By borrowing money, a fund can control a much larger position than its own capital would allow. This has the effect of magnifying both potential gains and, crucially, potential losses. Another defining feature of the hedge fund world is its unique fee structure, commonly known as 2 and 20. This consists of 2 parts. The 2 refers to the management fee, which is typically around 2% of the total assets under management each year. This fee covers the fund's operational expenses, like salaries and research costs, and is paid regardless of performance. The 20 is the performance fee. This is the real incentive for the fund manager. It is a share of the profits the fund generates, traditionally 20%. This fee structure is designed to align the interests of the manager with the interests of the investors. The world of hedge funds is incredibly diverse, with firms pursuing a vast range of strategies. Let's briefly touch on a few major categories. The classic strategy is long/short equity. Here, a fund manager builds a portfolio of stocks they believe are undervalued and will rise, the long positions, while simultaneously short-selling a portfolio of stocks they believe are overvalued and will fall, the short positions. The goal is to profit from skilled stock picking while hedging out some of the overall market's unpredictable movement. Another well-known strategy is global macro. These funds make large-scale bets based on their analysis of global economic and political trends. They don't just trade stocks. They trade everything, including currencies, interest rates, commodities, and entire stock market indices, to capitalize on their top-down view of the world. A third category is event-driven. These funds seek to profit from specific corporate events, such as mergers, acquisitions, or bankruptcies. A common event-driven strategy is called merger arbitrage. When one company announces it is acquiring another, the target company's stock price usually jumps up, but often trades slightly below the official offer price due to the risk that the deal might not close. An arbitrager might buy the stock at this small discount, betting that the deal will be successfully completed, at which point the stock will rise to the full offer price, delivering a small but relatively predictable profit. It's helpful to quickly compare hedge funds to the private equity firms we discussed in the last chapter. Private equity firms buy entire companies, take an active controlling stake, and have a very long-term investment horizon of many years. Hedge funds, in contrast, typically trade in liquid, publicly traded securities, are passive minority investors with no control, and have a much shorter investment horizon that can range from a few hours to a few months. In conclusion, hedge funds are sophisticated investment vehicles for accredited investors, characterized by their strategic flexibility, their use of tools like short selling and leverage, and their performance-oriented fee structure. They are a major client for the sales and trading divisions of investment banks, and represent a dynamic and complex part of the financial ecosystem. Now that we have explored the major players on both the sell side and the buy side, our next chapter will focus on a crucial role that supports this entire ecosystem: the research analyst. Thank you for joining us. Welcome back to A Beginner's Guide to Investment Banking. In our recent chapters, we've explored the sophisticated world of the buy side, looking at how private equity firms and hedge funds operate. A common thread for both is their relentless need for high-quality information and deep analysis to inform their decisions. This raises a key question: where does a significant portion of that external analysis come from? The answer lies within a crucial division of the investment bank: equity research. Today, we explore the role of the research analyst, the industry expert, the financial modeler, and the opinion maker who supports the entire financial ecosystem. Before we proceed, we must provide our essential disclaimer. The work of a research analyst, including the ratings and price targets they publish, represents their professional opinion and the opinion of their firm. This information is intended for sophisticated institutional clients and is for informational purposes only. It is not investment advice for the general public. It is not a guarantee of future results, and it should never be the sole basis for any financial decision. All investing involves risk. So what is a sell-side equity research analyst? A sell-side analyst, who works for an investment bank, is a specialist dedicated to covering a specific group of publicly traded companies within a single industry. You might have a software analyst who covers 10 to 15 software companies, a biotech analyst who covers emerging pharmaceutical firms, or a retail analyst who covers major department stores. Their primary objective is to become a leading authority on their sector. They do this by conducting incredibly deep, fundamental research to develop a unique perspective on the companies they cover, which they then share with the bank's institutional clients, the hedge funds and mutual funds we've discussed. The analyst's work can be broken down into 4 core responsibilities. First and foremost, they build and maintain detailed financial models. For every company they cover, the analyst creates a complex spreadsheet that forecasts the company's income statement, balance sheet, and cash flow statement, often for many years into the future. This model is a living document, constantly updated with new information, especially every 3 months when a company reports its quarterly earnings. Second, the analyst performs extensive qualitative research. This goes far beyond just the numbers. They regularly speak with the top executives of the companies they cover, such as the CEO and CFO. They conduct what are called channel checks, which means talking to a company's customers and suppliers to get a real-world, on-the-ground understanding of business trends. They attend industry trade shows and conferences to stay on the cutting edge of new technologies and the competitive landscape. Third, the analyst's work culminates in the publication of research reports. These are the tangible products of their labor. When an analyst begins covering a new company, they will publish a comprehensive initiation report, which can be over 100 pages long and serves as a definitive guide to the business. More frequently, they publish earnings notes, which are quick updates analyzing a company's latest quarterly results. They may also write broad thematic reports about a major trend impacting their entire industry. Finally, based on this exhaustive quantitative and qualitative work, the analysts must formulate an investment thesis and a rating. This is their published opinion. The rating is typically a simple buy, hold, or sell. A buy rating generally suggests the analyst believes the stock will perform better than the overall market over the next year. A sell suggests they expect it to underperform. Along with the rating, the analyst will also publish a price target, which is their projection for where they believe the stock price could go over the next 12 to 18 months. Again, this is a professional forecast, not a fact. Now, it is absolutely critical to revisit the concept of the Chinese wall. Regulations and firm policies create a strict information barrier between the equity research division and the investment banking division. The bankers on the deal-making side have confidential, non-public information. The research analysts operate in the world of public information and opinion. To prevent conflicts of interest or the appearance of insider trading, an analyst's research must be entirely independent and unbiased by any M&A deal or IPO that the banking side of the firm might be working on. So who uses this research? The primary consumers are the bank's institutional clients. A well-respected analyst with a strong track record is a valuable asset for the bank. The bank's institutional sales team will use these high-quality research reports to service their buy-side clients, helping them stay informed and providing them with an expert's perspective. For a hedge fund manager who has to track hundreds of companies, the detailed work of a dedicated sell-side analyst can be an invaluable resource. In summary, the equity research analyst is the investment bank's in-house expert. Separated by a strict Chinese wall from the dealmakers, they perform deep, fundamental analysis on a specific set of companies. They then publish their independent opinions through research reports, ratings, and price targets to provide valuable insights to the bank's institutional client base, fueling the intellectual engine of the capital markets. Now that we have covered the key roles and players, our next chapter will look at the framework that governs their actions. We will explore the guardians of the gate, the role of compliance and regulation. Thank you for joining us. Welcome back to A Beginner's Guide to Investment Banking. Over the course of this series, we have explored the high-stakes world of M&A, the complexities of capital markets, and the sophisticated strategies of buy-side firms. But none of these activities happen in a vacuum. The entire global financial system is built upon a dense framework of rules, laws, and oversight. Today, we meet the guardians of that framework, the external regulators and the internal compliance departments that ensure everyone plays by the rules. As we discuss these topics, it is absolutely essential to state our disclaimer. This chapter provides a high-level, simplified overview of the U.S. financial regulatory landscape for educational purposes only. It is not legal advice. Financial regulations are incredibly complex, subject to constant change, and require expert legal counsel for any application in the real world. To start, let's ask a fundamental question. Why is all this regulation necessary? The core reasons can be broken down into three main principles. First, to maintain fair, efficient, and transparent markets. Regulation helps ensure that the prices of stocks and bonds are set by the genuine forces of supply and demand, not by fraud or manipulation. Second, to protect investors. Rules are in place to shield investors, from the largest pension funds to the smallest individual savers, from dishonest practices. And third, to reduce systemic risk. This is the risk that the failure of one or two large firms could trigger a domino effect and threaten the stability of the entire financial system. A lesson learned firsthand during the 2008 financial crisis. The oversight of the U.S. financial industry is handled by several key bodies. The most important external guardian is the Securities and Exchange Commission, or the SEC. The SEC is an independent agency of the United States federal government. Its primary mission is to enforce federal securities laws, propose new rules, and regulate the securities industry. The SEC requires public companies to disclose meaningful financial and other information, allowing investors to access the facts and make informed decisions. It is the SEC that reviews the detailed registration documents, like the S-1, before a company can go public in an IPO. Working alongside the SEC is the Financial Industry Regulatory Authority, or FINRA. FINRA is a self-regulatory organization, which means it is a private corporation that regulates its own member brokerage firms and exchanges. It writes and enforces the rules that govern the ethical activities of virtually all registered securities professionals in the U.S. Think of the SEC as the federal government setting the major laws, and FINRA as the day-to-day supervisor, ensuring that the industry's participants conduct themselves fairly and honestly. In addition to these external regulators, every investment bank has its own internal police force. This is the compliance department. The mission of a bank's compliance team is to ensure that every single employee, from the most junior analyst to the most senior managing director, understands and adheres to all applicable laws and regulations, as well as the firm's own internal policies. Compliance departments have several critical functions. They are the architects and enforcers of the Chinese wall, the information barrier we've discussed. They use technology and procedures to monitor communications and restrict access to confidential information, preventing it from leaking from the private side of the bank, like M&A, to the public side, like sales and trading. A major focus is the prevention of insider trading. This is the illegal act of trading a security based on material, non-public information. Compliance departments monitor all personal trading activity by bank employees, often requiring them to get pre-clearance before they can buy or sell any stock. They also conduct extensive surveillance of the firm's own trading activities to detect any suspicious patterns. The modern investment banking industry has also been profoundly shaped by landmark legislation. The Sarbanes-Oxley Act of 2002, often called SOX, was passed in the wake of major accounting scandals. It dramatically increased the personal accountability of corporate executives for the accuracy of their financial statements and mandated a much stricter separation between a bank's equity research and its investment banking functions to ensure analyst independence. More recently, the Dodd-Frank Act of 2010 was enacted in response to the 2008 financial crisis. This was one of the most comprehensive financial reforms in U.S. history. It created new agencies to monitor systemic risk and introduced a wide range of new rules for banks. One of its most well-known components is the Volcker Rule, which, as we discussed in an earlier chapter, placed significant restrictions on the ability of large banks to engage in proprietary trading, that is, trading for their own profit. In conclusion, the world of investment banking does not operate in a Wild West environment. It is a highly structured and heavily regulated industry. External bodies like the SEC and FINRA set the rules of the road, while internal compliance departments act as the gatekeepers, ensuring those rules are followed every single day. This complex framework is constantly evolving, but its core purpose remains the same: to foster a financial system that is stable, fair, and worthy of investor trust. Now that we understand the rules of the game, our next chapter will look at how one can join the team. We'll explore pathways to Wall Street, skills and careers in investment banking. Thank you for joining us. Welcome back to A Beginner's Guide to Investment Banking. We have journeyed through the core functions of a bank, met the key players on both the sell side and the buy side, and understood the regulatory framework that governs them all. But what about the people? What combination of skills and attributes is required to do this demanding work, and what does a career in this field typically look like? Today we explore the pathways to and through Wall Street. Before we begin, we must provide our most important disclaimer for this topic. This chapter describes common skills, recruiting channels, and career paths for informational and educational purposes only. It is not career advice. The recruitment process for this industry is extremely competitive and subject to constant change. This overview is not a guide for how to get a job, nor is it a guarantee of employment or any specific career outcome. So, what does it take to become an investment banker? The required skill set can be divided into two main categories: the technical hard skills and the essential soft skills. Let's start with the technical skills, which are the price of entry, especially for junior roles. At the top of the list is financial modeling and valuation. As we've discussed, the ability to build a robust three-statement financial model from scratch in Excel, and to perform various valuation analyses like a DCF or a comps analysis, is the absolute bedrock of an analyst's toolkit. Closely related to this is a deep fluency in accounting. Accounting is the language of business, and a banker must be able to read and interpret a company's financial statements, the income statement, balance sheet, and cash flow statement, as effortlessly as reading a book. Finally, there is an expert-level proficiency in Microsoft Excel and PowerPoint. In banking, these are not just software programs, they are the primary tools of the trade. The work requires not just knowing the functions, but being able to use them with incredible speed and perfect precision to analyze data and present the findings in a clear, compelling way. But technical skills alone are not enough. The soft skills are what truly differentiate individuals in this field. Perhaps the single most important soft skill is an almost obsessive attention to detail. In a world of multi-billion-dollar transactions, a single misplaced decimal point or incorrect number can have enormous consequences. Next is an extraordinary work ethic and resilience. As we saw in our Day in the Life chapter, the job is characterized by long hours, tight deadlines, and immense pressure. The ability to maintain a high level of performance and a positive attitude in a demanding environment is crucial. Finally, strong communication and teamwork skills are essential. Investment banking is a team sport. Bankers must be able to distill complex financial topics into clear, concise language for clients and work seamlessly within the deal team hierarchy, where information must flow up and down the pyramid efficiently. So how do people typically enter this field? The most common entry point for the analyst role is directly from an undergraduate university program. Banks run highly structured on-campus recruiting processes, with the most critical component being the summer internship between a student's junior and senior years. A successful internship often culminates in a full-time offer to return after graduation. The other main entry point is for the associate role, typically filled by candidates from a Master of Business Administration, or MBA, program. These individuals often have several years of prior work experience in another field and attend business school to pivot into a career in finance. Once inside a bank, a career often follows the structured progression we discussed in our chapter on the hierarchy. An individual might spend 2 to 3 years as an analyst, mastering the technical foundations. They may then progress to an associate, managing the day-to-day workflow. From there, the path leads to vice president, where the focus shifts to leading deal execution and client management, and ultimately to managing director, who is responsible for high-level client relationships and generating new business for the firm. However, many people view the initial years in investment banking as an intense and invaluable training ground. The skills and experience gained are highly sought after, and can open doors to a wide range of other opportunities. These exit opportunities are a key feature of the career path. The most common path is to the buy side, moving to firms like the ones we've studied. Private equity firms and hedge funds are primary destinations, as the rigorous analytical skills developed in banking are a direct prerequisite for roles in those fields. Another popular route is corporate development. This involves joining a large corporation and working on its internal M&A and strategy team. In this role, you become the client, helping your company identify, evaluate, and execute its own acquisitions. Others leverage their financial and strategic acumen in the world of entrepreneurship and startups, either by founding their own company or by joining a growing venture in a key finance role, like a chief financial officer. In conclusion, a career in investment banking is built on a foundation of sharp technical abilities and indispensable soft skills like resilience and a keen eye for detail. While the path within a bank is clearly structured, the rigorous training it provides serves as a launchpad for a wide variety of esteemed careers across the financial and corporate landscape. In our final chapter, we will tie everything together, summarizing the key takeaways from our series, and taking a brief look at the future of this ever-evolving industry. Thank you for joining us. Hello, and welcome back for the final chapter of A Beginner's Guide to Investment Banking. Over the last 14 chapters, we have journeyed deep into the heart of the financial world. We set out with a simple goal: to demystify this complex and powerful industry, breaking down its core functions, introducing its key players, and explaining the rules of the game. In our final chapter today, we will distill the most important lessons from our journey. Then, we will turn our gaze to the horizon to explore the powerful forces of technology and culture that are actively shaping the future of investment banking. First, let's summarize the fundamental takeaways from this series. If you remember nothing else, hold on to these core principles. The most important concept is that investment banks act as essential intermediaries. They are the bridges that connect companies and governments that need capital with the investors who provide it, allowing for economic growth, innovation, and strategic transactions. We learned that the bank is a house divided, separated by a strict Chinese wall. On one side, the investment banking division provides strategic advice on mergers and acquisitions, and helps companies raise capital in the primary market. On the other, the sales and trading division provides liquidity and facilitates trading in the secondary market. At the heart of the advisory business is the core skill of valuation, which we found is both a science and an art. It is a science of rigorous financial modeling, but an art of professional judgment, with the goal of determining a fair and defensible value range for a business. We also saw that banking is not a monolith but a diverse ecosystem of firms, from the massive full-service bulge brackets to the specialized elite boutiques, all interacting with a sophisticated buy-side of private equity firms and hedge funds. Finally, we learned that this entire industry is built upon a robust foundation of regulation and compliance, designed to protect investors, ensure fairness, and maintain stability. With these foundational principles in mind, let's look forward. The investment banking industry is not static. It is constantly evolving. Three major trends are shaping its future. The first and most powerful is the technological revolution. The rise of financial technology, or fintech, and especially artificial intelligence, is changing how work gets done. AI and advanced automation are now being used to handle many of the routine, data-intensive tasks that were once the sole domain of junior analysts. This includes gathering financial data, building initial valuation charts, and even drafting sections of marketing materials. This allows bankers to spend less time on manual processes and more time on high-level strategic thinking. AI is also enhancing analytics, allowing firms to sift through vast datasets to identify potential M&A targets or predict market trends with greater speed and accuracy. However, this does not mean the banker is becoming obsolete. The core functions of building client trust, providing bespoke strategic advice, and navigating complex human negotiations remain uniquely human endeavors. Technology is seen as a powerful tool that augments, rather than replaces, the expert advisor. The second major trend is the growing importance of ESG, which stands for environmental, social, and governance criteria. For years, these were considered secondary concerns. Today, they are at the forefront of corporate and investor strategy. Companies are now judged not just on their profitability, but on their environmental impact, their commitment to social responsibility, and the quality of their corporate governance. This has created a new and expanding line of business for investment banks. They are now advising clients on how to improve their ESG ratings, structuring green bonds, specifically to fund sustainable projects, and integrating deep ESG due diligence into their M&A processes. A target company's hidden environmental liabilities or poor labor practices are no longer just ethical concerns. They are significant financial risks. Finally, the industry continues to adapt to an ever-evolving regulatory environment and a new war for talent. In the wake of the 2008 financial crisis, a wave of new regulations reshaped the industry. That focus on stability, transparency, and data security continues to intensify. At the same time, investment banks are no longer just competing with each other for top talent. They are in direct competition with the technology giants of Silicon Valley and dynamic startups, all vying for the brightest analytical minds. This has prompted banks to invest more in technology, offer more flexible career paths, and re-emphasize their roles as centers of learning and development. In closing, while the tools, the rules, and the culture of investment banking are in a state of constant transformation, its fundamental purpose endures. The world will always have innovators who need capital, and successful companies that need expert strategic advice to navigate their most critical decisions. The role of the trusted advisor who can provide that guidance remains as crucial today as it has ever been. We sincerely hope this educational series has been informative and has helped demystify this complex industry. Please remember, this entire series has been for informational and educational purposes only and is not, under any circumstances, to be considered financial, investment, legal, tax, or career advice. Always consult with licensed and qualified professionals for any such guidance. Thank you for joining us on this journey.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.